Hello, yes, it's Salah Nasri here, and yes, I have a special announcement. The Game of Chips has just hit 5,000 orders on Amazon. Thank you to everyone who placed the order. The book was just released in December, so I'm very, very grateful and surprised to date. If you are someone who is intrigued, curious about how the semiconductor ecosystem works from beginning to where we are right now, this book was written with you in mind. So order it, read it, and it is pretty much a handbook of the whole ecosystem. In the meantime, enjoy the next episode and don't forget to hit that subscribe button.
We invested in Groq with a Q back in early 2020. The business model pivoted 4 times. Okay, so you don't need to necessarily figure out the business model, but you still need to have a view on your unit economics. And they may change over time, and the board, if you've invested in the company, you can support these pivots. But at the end, you need to have a sense of your spreadsheet, of your numbers. That, I think, is a discipline you need to have. And again, these numbers will not mean much. It's unlikely they will be precise. And sometimes you have false precision.
Great CVC governance is...
That's a good question. Because if you think you're predicting the future, you're going to end up building a portfolio that's highly correlated. If you're right 6 years early, you end up not being able to get the startup funding. That's basically the death of the startup.
Our guest today is Nicolas Sauvage, president of TDK Ventures. He operates at the intersection of capital, physics, and long-term judgment. He backs founders years before they're obvious, when conviction feels indistinguishable from risk.
This conversation is about leadership under uncertainty, about decision-making when spreadsheets fail, and why sometimes the hardest choice is not choosing growth.
I want to see an entrepreneur who thought so much about it, but yet when you ask questions and you challenge them, they're willing to retest and change their hypothesis if they agree that there's something to change. But what matters more is how big could it get if it gets really successful? Unless you have a tactical reason not to, have to have the potential to return the full fund.
So then my question would be, what's your 4-year prediction that you're willing to be judged on?
We don't have a crystal ball. Our job is actually to dream different type of futures which are uncorrelated.
Hello and welcome back to the Semiconductor Leadership Podcast. I'm your host, Salah Nasri, and whether you are an industry veteran or someone who's just curious about semiconductor manufacturing, this is your podcast. Before I start the episode today, I have a very small favor. When I look at the back end, we've hit more than 200,000 views in just under a year. But only 3% of you are subscribed to the platform. So do me that little favor and hit that subscribe button. We are on Spotify, we're on YouTube, and we're on Apple Podcasts. So, ladies and gentlemen, without further ado, it is with great pleasure to introduce a dear friend of mine, a mentor, a life mentor. It is none other than Nicolas Sauvage, the president of TDK Ventures. Nicolas, welcome to the show.
Thank you for having me, Salah. It's so cool.
It's a pleasure to be here, and thank you. I mean, this is being shot live and direct in your headquarters here. So people can see the TDK Ventures at the back of the screen and on your T-shirt. How does that make you feel, Nicolas?
Oh, I love it.
Yeah.
I love it. No, I think it's really cool to host you here. I think it's not the first time you come here. Last time you came with quite a few Stanford classmates to ask us questions, meet with the team. So it's good to have you back and to do it here.
Thank you. I mean, first of all, one needs to give credit when it's due. So congratulations on the remarkable success that TDK Ventures has done since its inception. And I know you're going to say this is just the beginning, Salah, we're just getting started. So yes. I want to start off the session with people who don't know the great Nicolas Sauvage like I do, or TDK Ventures, with some rapid fire questions. So in one line, your fund superpower.
Well, before that, I want to say we are not yet successful.
Not yet successful. I mean, the numbers speak
No.
amount of unicorns.
For me, success is very simple. It's helping TDK build the next billion-dollar businesses and return the funds. So I want to do at least 2x on every single fund, which, by the way, means that we would have invested in amazing companies, which would have become the best possible partners, customers, suppliers to TDK. So for me to be able to say that we have achieved success would mean that we have built these billion-dollar companies inside TDK, organically or inorganically, and return more money than we've asked, and hopefully way more than that, 2x, 3x.
But don't you feel that you're hitting the barrier far too high in comparison to other CVCs out there or VCs? You've already done
what you said.
But you've done a remarkable job already. I mean,
I think we have a very promising start. I think we have an amazing portfolio of 49 companies today that are really breakthrough leaders.
Sure.
And what we are trying to do is to invest in what we call King of the Hill. The startups we believe will become the market leaders 5 to 7 years from now. If we are correct, and hopefully we're correct more times than not, we are going to be able to get, of course, the right financial returns, but we're going to build the intimacy between these portfolio companies and the many TDK groups that will be building that intimacy with these future market leaders. And that's how I'm hoping our teams in TDK will start to learn about the future, because if you think about the future, it's built by entrepreneurs. And we are backing the entrepreneurs who are building this solution that we know is needed for the future.
Okay. Let's go through the rapid fire questions.
Sure.
And then I'm gonna dig in deeper in the theories that you're working on.
Yeah.
So in one line, Nicolas, your fund's superpower.
I think it all comes from that TDK goodness we bring to our portfolio companies, most of it coming from our mothership, TDK and all the TDK companies. And so if you think about the journey of an entrepreneur, it's about de-risking their journey. It's about how do you go from science risk, de-risked, to engineering risk, de-risked, to go-to-market, to scaling, and so on. And we can bring so much of that goodness, of that de-risking coming from our mothership. So I think the superpower starts, and as it should for any corporate VCs, it starts with the mothership superpower.
Right. Fast, no, or slow, maybe, which is kinder in your world?
Fast, no is kinder.
Okay.
Yeah, and if I think about our statistics, for one yes, we say no to 200. And I would say that for 180 to 190 out of 200, it's a fast no. And we try to be very precise. We try to be helpful. I wrote an article on Medium, which is about entrepreneurs deserve a better no. And we try to live to that ethos of being very helpful even when we say no. What people don't say is that in venture capital, it's actually the last 10 that are very tough to say no. But that's also where you take a longer time. It's more of a slow no, because you want to understand why you would want to invest and why you wouldn't want to invest.
Seed or Series A or Series B? What's your favorite entry point and why?
Oh, seed. It's risk. I don't think it's about risk. At the end of the day, every series is risk-adjusted pricing. So our job is to make sure that we invest at the right pricing for a given risk. So the valuation will grow over time as you de-risk the project. So I think this is not about risk. I think the reason I love seed more than any other series is that it's about the founder and the founder market fit. What it is that this founder knows that no one else knows, and why do they believe they can build a solution that's solving a real problem in a market that's big enough. And that's intellectual debate with a founder, trying to understand what they see that no one else sees, is really exciting. And if you think about our job, it's about, especially in deep tech, and I'm sure you will ask about software in the future, but if you think about deep tech, it's about being right 4 years before it's obvious. And so we want to meet with founders who are thinking about the solution that's not obvious today, And then 2 years later, when we have invested and the next round of funding comes 18 months to 24 months later, a few other investors start to see what we saw. And then the next round, which is basically 4 years later, that's when it starts to become obvious and everyone comes in. The challenge is, if you're right 6 years early, you end up not being able to get the startup funding. That's basically the death of the startup. And if you're right 2 years early, it's priced in. So you're already not going to get the best financial returns. And if you invest when it's already obvious, and we look at the bubbles everywhere now, it's priced in. And your odds of doing well is probably very, very small. So it's all about finding this founder market fit in something that I believe 4 years later will start to become obvious.
What's one diligence signal you weight more than most?
One.
Yes.
I think it's tough to say one, but I think I want to see someone who's thought so much about building a solution to a real problem in a big enough market, but they thought so much about it that they have thought about every angle and what could go right, what could go wrong. So I want to see an entrepreneur who thought so much about it, but yet when you ask questions and you challenge them, they're willing to retest and change their hypothesis if they agree that there's something to change. So in a way, it's a kind of a conviction, but loosely held, so that they know where they want to go, but they are willing to change the how if they see a better path to get to their mission.
What's the most overrated VC metric? I could say CVC metric too.
Well, I think many investors, rightly or wrongly, but I think it's overrated, is who else is investing. And so I think you need to build conviction. It's back to what I said earlier, which is you want to invest 4 years before it's obvious. And if your signal is who else is investing in the round, I think you're priced into a higher valuation. You're not getting any advantage from having built your own conviction. So yeah, I would probably say who else is investing is good. It's a useful signal, but that shouldn't be your signal to invest if you're very early stage. That's very different if you're later stage, but early stage like we do, I think that's something that could be overrated.
And what is the underrated one?
So there is one thing which I think I like to see entrepreneurs being very good storyteller, being very responsive, and being able to be very cogent in writing. And it's interesting how often entrepreneurs don't spend the time to explain well and to be responsive and to be very cogent when they write. And that tells me something, which is these entrepreneurs are going to struggle winning customers, because that's what you need to win customers. They're going to struggle winning partners. They're going to struggle winning other investors. And so their journey is going to be so much harder if they are not cogent when they write. And for example, if they prefer to always be on call versus writing back. I think there is something to say about someone who can tell a very good story and not afraid to tell the story in writing and committed to writing.
From your perspective, what's a KPI that proves platform value is real and not just vibes, as in storytelling?
I don't know if I'm answering your questions, but I think what matters the most for anything we invest is unit economics. If you want a company to be doing well, you need that unit economics to start to get to a positive unit economics, and then at some point, really good unit economics. Once you do that, you have the freedom to operate and to scale and to bring all the benefits to society, if you invest in clean tech, to the planet, that you have promised to deliver. And it's okay to actually start with negative unit economics. That's why venture capital has a place to play, because we can invest in a non-profitable business, but we have to have conviction from first principle that that business can get to positive unit economics. And without that, I don't think we should ever invest. And there is an argument whether, for example, you have subsidies and countries that subsidize and that give grants, whether that should fit into the unit economics. And I would argue that we should underwrite absent of any grants, absent of any subsidies. You have to believe that the unit economics will become positive fast enough to the point where you never needed them. And they have a big place to play. So I'm not saying that we shouldn't get countries to be smart about subsidies, but they should be about accelerating a business case, making sure that you start to have technologies that you want faster to scale, faster to deploy. But you need that true North Star of positive unit economics path.
Talking of countries, what region do you feel that's underpriced for deep tech opportunities out there?
So many. First, I'm all in India. We have a team, a kick-ass team in India that's doing amazing deep explorations. And by the way, our investment director based in India is not investment director India. He's investment director. So he's actually looking globally for who could be the king of the hill, that market leader of the future, everywhere around the world. We start with a reason why we think it would be in India, but we're looking everywhere. It doesn't help us to invest in the second or third most likely market leader if we find it in the US or in Europe or in China. So we want to make sure that we search globally for king of the hill. But we've invested in some of the king of the hill in India, which are truly remarkable. I mean, we invested in Exponent, for example, that do very fast charging. We knew they would be winning in India first before they go global. Why? Because anywhere around the world, OEMs have the power. In India, the three-wheelers are highly fragmented. I think you have more than 80 OEMs, which means that you as a startup building your BMS, your battery management system, you have way more power than you would if you're a German startup in Germany against BMW and Mercedes. And so they have the ability to provide a solution that the three-wheelers OEMs would want. And now they are scaling. They are even building electric bus that recharge all in 50 minutes. I mean, it's truly remarkable. That's what I mean by investing in a location where we believe has the highest potential for being the king of the hill, but we want them to be a global success. So I'm very bullish about India, and for many different reasons and for different verticals with different reasons. Like space technology, for example. India, I think, has so much advantages that they could become the real challenger even for SpaceX. So there is something to say about India. But if I think about Africa, like some of the countries like Kenya, they have so many advantages where you could see, like in mobility, the king of the hill. I think South America is very interesting. I don't invest in fintech, but they would be an obvious place, especially with Brazil, to be the challenger. So I think there are many geographies where the challengers will come from and that could really make a difference. I'll give another example, which is even furthest away in Australia. We invested in a company called Novalis doing direct lithium extraction. Why are we finding this king of the hill in Australia? That's because they have this mining expertise. They have universities teaching about mining. They are the best location to find the real experts who can find breakthrough in technology related to mining.
Wow.
I'm not sure it's a very fireside chat.
Yeah, I was saying, just getting in. I feel like I'm deep into the podcast already. Nicolas, if you had 10% more reserves this year, where would you deploy first?
Actually, I have a huge amount of reserve today.
Okay.
If I don't need 10 days, actually, I want to give credits to my team here. I think we are moving into 2026 with 2 active funds, each of $150 million. We have uninvested in 5 startups out of these 2 funds. We have huge amount of dry powder. And I'm really glad because I think 2026, I believe, is going to be our best vintage ever. We are going to see fewer investors being able to invest because they haven't returned enough money to the LPs to get more money from the LPs. And we are going to see the best entrepreneurs surviving and the best entrepreneurs thriving in the future. So I'm actually really happy to have a lot of dry powder so that I can invest in the very best entrepreneurs in 2026.
From your perspective, could you share, unfortunately, a failure that leveled up your investment process?
No, because we've had many failures, don't get me wrong, but I think every failure is actually about helping us improve our process. And so I think if I think about some of the failure was us doing a follow-on investment when the company was already very late stage. That's not actually helping us do anything more than what we are supposed to do. And so we've learned to not to do that. I think we've learned to be very disciplined on valuation over time, where we realize that maybe we were a bit too soft on valuation, and that also doesn't help us. That doesn't help the other investors. That even doesn't help the startup. Because if actually you're not very disciplined on valuation, maybe the entrepreneur feels good about that round, but then he's going to be challenged or she's going to be challenged in the next round. So you actually have to be very, very careful about valuation. And so I think all the failures we've had have helped us to improve our discipline and our process. And we are very reflected about this. So we spend a lot of time as a team reflecting on how do we improve. Once a year, we have what we call a reflection week. 5 days, everyone comes to San Jose, and we spend time on deciding what it is that we are going to stop doing, reducing doing, increasing doing, and start doing. And this all comes from what our entrepreneurs, our portfolio companies, our investors are telling us, because before that reflection week, we do a big survey to all our portfolio companies, at least 3 people from each portfolio companies, as well as investing partners. And we ask 3 questions. The first one is the typical NPS question with a twist, which is, how likely would you recommend TDK Ventures to another entrepreneur? So it's from an entrepreneur to an entrepreneur. This is kind of a high bar.
Right.
The second one is, what did we do well for you? And this is where we learn what we can double down on. And the third one is, what it is that we should have done better. And we learn so much, especially because we ask the positive, what did we do well? Then they really open up about what it is that we can do better. And then we reflect on that during reflection week as a team, and we decide how to improve. And so every year we are looking at how we can improve our processes to make sure that failures or disappointment or friction points are solved for the following year.
Marvelous. Finish the sentence, Nicolas.
Okay.
Great CVC governance is...
Great CVC governance is... That's a good question. Great governance CVC is... It's tough to answer this generically because I need to explain how I see the corporate VCs. Typically, you have 2 types of CVCs. You have the one who have an exploitation mission, which is to help the current business accelerate their current business. And it could be about finding go-to-market of their existing business. It could be about getting startups who are developing on the platform of the company, like Salesforce Ventures. And that exploitation, the governance, I would say, is about being very tethered and linked and incentivized with the mothership. And you want the teams in the mothership and the team in the CVC team to work really hand in hand. And that governance would be very different from what a corporate VC with an exploration mission would be. Exploration mission is about where you are not today. It would be new technology, new markets, new use case, new type of applications. And in that case, you want a very loose governance where the CVC can go where the corporation would not be able to go. They couldn't justify going. Maybe the risk is too high, or it's too early, or they don't have a business case. And at that point, the governance would be very, very different, where you want that corporate VC to be able to go very fast and to be linked to whoever owns the strategy in the mothership. Typically the CEO, but it could be the CSO, it could be the CTO. But you want to have that governance, which is much more loosely. And that's why I was struggling with your end of sentence, because it really depends very high level between the two. And by the way, this comes from our professor we have in common, Jesper Sørensen, who explained it so well with an analogy, which is exploitation is you're on a mountain together with your competitors, and your job is to go to the top of that mountain. And top of the mountain, you could say, is revenue, profit, customer delight, you choose. But your job is to get there. Well, exploration is like this tiny helicopter flying on a cloudy day, trying to discover new peaks, and then flying back with very little cost to say, hey, let's not go there. It's hostile, there is nothing to it. While this one, we should absolutely go. And that's where you can advise the mothership, who's focused on exploitation, where to go organically or inorganically in the future. So that's why I think the governance really depends on the mission, the why of the corporate VC.
Nicolas, one slide founders or entrepreneurs should always add but rarely do.
Unit economics. I think the path to unit economics, because the current view may be good, but I want to see how they think they will improve the unit economics over time and really be able to argue why it's improving over time. And you want to test the hypothesis, and no one will get it right. You cannot predict the future. You cannot predict many things. But I want to see how they are thinking about improving the unit economics over time. And if you understand that, you can then start to understand the full numbers that they would be presenting to you. But if you don't have the unit economics, which is very rare to see, sometimes you see the unit economic as of today or 5 years from now, but you don't see how that path improve over time. And that's basically the slide that's missing most times, which I would love to see more times.
Why do you think they avoid that most of the times?
Maybe they haven't listened to your podcast.
That's it, true. There you go. Take it to what's it? Bam. What's your litmus test for a truly strategic corporate partner?
And litmus test means something that you can very quickly identify that would be a good partner. I think they really look for an equal win partnership.
Equal. Okay.
And I think it's very important to understand what equal win means. And we really strive for equal wins at TDK Ventures. Most times a startup and a big corporate, when they say win-win, it's a tiny win and a very big win. Okay? And you would argue, nothing wrong, you still get your win as a startup. What happens in reality is that 2 years down the line, when the startup can afford to go out, they will stop that win-win and move to a real win-win, a real equal win with someone else. And so while you might think you have that big win as a corporate, you end up with nothing sustainable and you end up with resentment, potentially people not liking your firm. And so what we are trying to do is not to have any of this, even if it means we don't have the engagements, but we want to right-size the partnership. And that typically means we want to make sure it's highly valuable for the startup, highly valuable for the corporate, so TDK and all the TDK companies. If we right-size it, we have a sustainable long-term partnership that will last for decades. And TDK being a company that started in 1935, by the time your podcast is published in December, will be 90 years old. We are looking for decades-long partnership with suppliers, customers, and partners. So that equal win sizing with what we believe are the king of the hill, the future market leaders, matters a great deal.
Marvelous. You mentioned early on in terms of the success of making the right investments is identifying what's going to come in 4 years' time. So then my question would be, what's your 4-year prediction that you're willing to be judged on?
I actually don't need to do prediction. I think this is one of the things that most people don't understand about venture capital. We're not in no one can predict the future.
Well, you don't have a crystal ball, of course.
We don't have a crystal ball. We don't have an ability to predict the future. And it's actually the wrong way to think about it. Because if you think you're predicting the future, you're going to end up building a portfolio based on your conviction of what the future looks like. Which means that by definition, you're building a portfolio that's highly correlated, which means you're not building a portfolio to reduce risk. You're actually building a portfolio that has a systemic risk attached to it. Our job is actually to dream different type of futures which are uncorrelated work backwards from that state of the future, which, by the way, could be as negative or as positive as you want. We could imagine a world where all the materials that we have taken for granted going all around the world stop coming. We can assume that we can't get lithium and cobalt and nickel and whatever materials, we can't have them anymore, which, by the way, is a possible outcome of what's happening with geopolitics and politics. So that could be a type of future. We can also assume a future where all of these materials becomes very easy and flows, and we have them. We can imagine a future where it's a smart home, the dream home. We can imagine a future where energy becomes free. What does that mean when the energy becomes free? Or imagine when the future becomes compute for free. How democratizing that would be. But what does it mean for conflicts? Okay, so all of these features, they may not be very likely, but they're all uncorrelated.
Yep.
Then what we try to do is to go backwards from that type of future. And we look at what are the gaps from today to get to that future, and who are the entrepreneurs building solutions for that. And we try to find that king of the hill from that. And so that's why I don't think we have to pretend to be predicting the future. And even if we could, we shouldn't invest according to that. We should really think about a portfolio that is uncorrelated across a number of bets of what the future might look like. I'll give you a concrete example. We invested in a company called Peak Energy in the US. They do sodium-ion batteries for grid storage. And maybe in the future, they use different type of technology. But it comes from a very simple observation that, or an assumption of the future where we are not going to get lithium anymore from where we used to get them. Okay? If that's true, how are we going to power AI and all the hyperscalers behind? We can't if we don't have the lithium batteries, unless we find an alternative that's suitable to power these hyperscalers. And we believe that for grid and hyperscalers, you don't need energy density. You need very good temperature range support, for example, but you don't need energy density. So suddenly the solution of sodium ion storage becomes perfect fit for that. You don't need lithium, cobalt, nickel. You are completely independent. And if you're based in the US, you have all the materials highly available right here in the US. So that's how you can think about a future where you don't get materials. You look at which entrepreneurs are working on a solution and you invest in them.
Thank you for wrapping up the rapid fire round. I think that it's changed the word rapid fire to longevity answers, but I mean, you covered some very key topics. I think at the end of the day, what really is quite profound about the mission at TDK Ventures is you have this element of sustainability around your investments most of the time, and
all the time.
I mean, and I discovered a gentleman called Pascal Pistoria, and I was never aware of the guy, to be frank with you, even though I work a lot with ST Microelectronics. So when I heard about his passing not that long ago, I did a little podcast explanation and how he centered his focus when he merged SGS and Thomson, two different regions and mindsets, by the way, Italian and French, right?
Yep.
Putting both engineers together as well. And his initiative to differentiate was based on sustainability, way before sustainability was a thing. Yep. And he was saying that, a company can be profitable. And now everyone's on this, ESG train, which has kind of calmed down quite a bit. But there again, I always question ESG because of Professor Amit. If you've been to his classes at Stanford.
I don't think so. No.
Professor Amit, he's a character. But yeah, that's another story for another time. But talking of all of this, I think many don't know the story of TDK Ventures. How did it all happen? Like, where did the idea spark from, if you could share the story?
Yeah, it's funny because this is one where I can pinpoint exactly when the idea started, and 60 of my classmates can remember it. So okay. It's very simple. So I was at the Stanford Executive Program, which is a program you did after me, 6 weeks, which is really about rethinking the way you think about leadership, management, sustainability, and contribution to society. And we had this professor, Jesper Sorensen, I mentioned earlier, explaining this exploration.
Yes.
And I'm going to probably ban you from YouTube because of that. But I basically not shouted, but I was like, shit. I just had this realization, and then the class went super quiet. And then Jesper Sorensen came to me and said, I beg your pardon. And what's interesting about that is I started to explain, yes, I just realized at TDK we're so good at exploitation. We have our business company delivering and being very clear about what they need to deliver and so world-class at doing it. We are not doing the exploration the way you've explained it with a corporate VC. I think we should consider doing it at TDK. And at that point, Professor Sorensen got so excited saying, Exactly. Wow. So all my classmates still remember saying, how did you manage to get him so upset to so excited within 60 seconds? But the point is that the idea was really about, I felt like TDK could take advantage of a corporate VC to have this exploration mission, to be able to, at very low cost, we're talking like $2 million, $5 million, invest in one of the best entrepreneurs working on the topic of relevance, long-term strategy relevance for TDK, bring back that knowledge to say, we shouldn't go here, which is, by the way, deciding where not to go is for me the definition of strategy. But also deciding where to go and how to go and maybe deciding with whom to go. And so, yeah, that's when the idea of TDK Ventures started. And what's interesting is that night I went online, tdk.com, is there really no corporate VC? And I realized there was none. And so that at that time, the company was 83 years old and they never had a corporate VC.
I mean, you have two elements. It's not only 93 years old, it's also a Japanese company.
Yep.
So,
Well, not your typical Japanese company. So maybe I should explain about TDK a little bit.
Please.
90% of the teams are outside Japan. 90% of the revenue is outside Japan. So this is more of a global company, a tech firm, like you would think of Sony. Sony is Japanese, and clearly with all the goodness that comes from the Japanese culture, but very global. Same for TDK. So I should start with that. And if you look at our corporate officers, you have a big chunk of the corporate officers who are not Japanese. On top of that, all of the Japanese corporate officers spend really a long time outside Japan, driving and building businesses abroad, even before they go back to Japan, if they come back to Japan. So there is a openness, which is, I think, very, very different in TDK. And I think that explains in a way why someone who's not Japanese, who doesn't speak Japanese, I mean, I'm not based in Tokyo in the headquarters. I was based here in Silicon Valley. I just come from an acquisition not even a year earlier when I pitched it, this concept of CVC. I think that explains why TDK not only approved a corporate VC design, and of course I had a partner in crime called Ikushima-san, who really helped me, because as much as I didn't understand TDK, which in a way is a superpower to propose something very novel, you need someone on the other side who really understands how TDK think to bring maximum value to TDK. And so I'd like to think that Ikushima-san and I were the perfect partners to create the best possible design for what became TDK Ventures.
Wow. So your motto is scaling impact scalers.
Yes.
What does impact mean?
Exactly.
Yeah. What does it mean in this context?
Well, first, impact scalers, we believe, are the true entrepreneurs. If you think about the best definition of an entrepreneur is someone who's starting something from scratch that does not exist, build a solution to a problem that's very impactful. And so impact scalers, because we are looking for people who are going to bring positive impact and scale it. And it's very important because many times you have a solution that's not really a positive impact. We would not invest. And that's part of what you said about sustainability, which is unless it has a real contribution to society and to the planet, we are just not going to invest. But there is a second element, which is it could be a beautiful impact to society, but it's a very niche type of impact, or it's one that cannot scale because of unit economics or for different reasons. That also doesn't help us. What we want is to invest in what we call impact scalers, which is very ambitious, full of grit, with this type of superpowers, which I mentioned earlier about founder market fit, which sometimes actually start with founder technology fit or founder product fit. But I like the founder market fit and really going to make a massive impact because, again, they will get to this positive unit economics, which allows for scalability, which allows for big market to be addressed.
Marvelous. You're in the deep tech world. Normally, it requires quite a long amount of time, right? The average they say is 8 to 12 years horizon. Yet you see some CVCs, some VCs behave like they're investing in SaaS businesses. What do you feel is like the biggest mistake that these type of CVCs or VCs make when applying software timelines to hardware or science-based timelines?
And maybe we should talk about why the timelines are different. I mean, we invested in a company called Type 1 Energy, building nuclear fusion plant systems, okay? So you have science risk. You have engineering risk. Then you have business model, go-to-market to figure out. Then you have scaling, and scaling is its own engineering challenge. That is something that's very, very specific on the science and the engineering, which typically you don't need to worry about as an investor for software. And of course, the timelines are very different between building a nuclear fusion plant for the very first time versus building with Cursor by tomorrow a prototype you could test with people and see whether it's picking up or not. So we're not in the business of investing in software business like this. So I can't comment about how the investors think that way. But what we are trying to do is to do what we call deep explorations, which means that our investment team are going to pick, and that's bottom up. They choose the topics they are passionate about, and they are going to spend months, typically 6 to 9 months, to really get deep onto a topic, build convictions from first principle, surface it to the team where they will get challenged in what we call devil's advocate sessions. And if they survive this challenge from their peers, publish it. And sometimes publish means we decide not to invest, we decide to invest, but we can't find the king of the hill. We decide to invest, we found the king of the hill. Okay? That's what we're looking at. We do these deep explorations. And when we end up investing, it's because we have this high conviction that we've challenged each other.
So, I've also heard that some CVCs and VCs, they rely too heavily on spreadsheets and not enough on the physics or manufacturing capabilities. So what is your critique of, let's say, financial first VC sovereign funds, hedge funds evaluation in deep tech?
No, I think that it's the right way to do it. Because you're talking about late stage investments. That's a totally different discipline than I know.
But it's more about early stage investment.
Yeah, so if we start thinking about early stage, I actually think you need a spreadsheet and you need to work this unit economics and you need to understand how the company is going to make money. And maybe you haven't figured it out, which is fine. We invested in Groq with a Q back in early 2020. The business model pivoted 4 times. Okay, so you don't need to necessarily figure out the business model, but you still need to have a view on your unit economics. And they may change over time. And the board, if you've invested in the company, you can support these pivots. But at the end, you need to have a sense of your spreadsheet, of your numbers. That, I think, is a discipline you need to have. And again, these numbers will not mean much. It's unlikely they will be precise. And sometimes you have false precision when I see spreadsheets which has like 7, 8, 9 and something like this. It's false precision. You have to be careful about this. But what you want is to make sure that you understand how the company could make a really big success. And actually, if you think about venture capital, and maybe that's something that most people underappreciate, back to one of your earlier questions, is the power law. And the power law is interesting because most people think they understand it. The power law is when it's, if you are on a power law and you look backward, it looks totally flat. Wherever you are on this curve, it looks flat. You look forward, it looks like a wall. And intuitively, we think that we understand the power law. I would posit it's impossible, maybe because of the way our brain thinks, to think about power law. I'll challenge you now, okay? Let's take a piece of paper, a very big piece of paper, and let's assume you can keep folding it as many times as you want. There's no limit to how many times you need to fold it. How many times do you think you need to fold it from this floor all the way to the moon?
A ridiculous amount of times.
Huge amount, right? But give me a number.
Billions. It's got to be a lot of folds.
Yeah?
Yeah.
Yeah. I think it's 43 times. You don't need to fold it. It's 2 to the power of 43. Think about it. You fold it 10 times. It's 2 to the 10. It's 1 time.
Right.
So you get 3 orders of magnitude every time you fold 10 times. Okay? That's the power law.
Okay.
That's the power law. Let me challenge you a little more. Let's say you keep folding it.
Right.
How many times do you need to fold it to get to the end of the universe?
Well, there's an infinity, isn't it? It's a never ending.
End of the universe.
The universe, there is no end to the universe. There's galaxies, Milky Way.
Oh, yeah, way beyond that.
Yeah.
It's the limit of that universe.
That's infinity.
It's not infinity. Give me a number.
I can't give a number, but it'll be in the trillions, zillions. Yeah.
Yep. 103.
How did you calculate that?
All in my head. No, it's not the first time I asked the question. The point is, every tenfold, 3 orders of magnitudes bigger. And so you get very, very big to very big numbers. Okay. And this is the point is, when you think about venture capital, most people think about what could go wrong. And you need to do that. You need to do that, but not from a financial point of view, but more from being open to what could go wrong so you could mitigate it if you invest. But what matters more is how big could it get if it gets really successful? And that's on that you should be investing, which means that every single investment, let's say you build a portfolio of 20 or 25 companies, every single one of them, unless you have a tactical reason not to, have to have the potential to return the full fund. So you're looking at a 20x to a 50x potential for every single portfolio company you invest. And by the way, it's even harder in deep tech because the capital efficiency is not the same as software. So you need to make sure that your dilution is calculated into that potential for fund returner. So the power law is very important, and this is where you being very, very disciplined about what the numbers might look like in the case of success is very hard, but very important.
So you also emphasize on cutting noise to focus deeply. What is the biggest source of noise that you feel for tech entrepreneurs today?
Again,
and how should they remove it as well?
Okay, for entrepreneurs who are starting to build a solution, noise is listening to what's happening right now, because they should be finding investors who are going to bet on what they are building, which is not obvious today, but hopefully becomes obvious in 4 years. And so anything that would influence them to make good decisions about building that solution, that's signal. Everything that's about bubbles and AI or whatever it is that sounds like irrelevant to their decision making, that's noise. And so I think the best entrepreneurs will go with their conviction and know when it's signal and when it's noise.
Going back to talking about one of the best things that I think is the best advice you ever told me to do is to do the exec program at Stanford. But
it changed you.
Oh, big time. No, absolutely. It changes everybody, anybody that's been there. I mean, a lot has happened, and it seems that everybody's life changes instantly by going to this platform. But you not only that, you've also done INSEAD, you've done LBS as well. What's the biggest thing that you learn in terms of innovation, culture, how they differ, and where entrepreneurs thrive the most in this
I think
experience?
it's interesting. So you mentioned INSEAD. So it was a 1 week training and it was about sales. Okay. But what was very interesting is a Wednesday, we had a full day on decision making and the science of it.
Mm-hmm.
And what's interesting is that before going to that training, you had to do some tests. One of the tests was about what would you take if you were lost at sea on a small boat. And you had a number of items like mirror, chocolate, water, and all of this. And you had to pick what was the most important number one, then number two, number three, number four, and so on. And of course, you have to answer that test 3 weeks earlier, so you completely forget about it by the time you do your training. But what's interesting about this ranking is that there is an ideal ranking from the, I think, US Army, who have actually said number one should be this, number two should be that, and so on. And so you could very quickly group people between being expert, totally clueless, or kind of average. And clueless, by the way, could be very orthogonal to each other. So you could be clueless, but you believe chocolate is the most important and water is the most... You could have very high diversity on the clueless part. Average, you could have some diversity. And of course, experts are all aligned. Okay? What's interesting about this is it was on Wednesday, so we already spent 2 days as a group. And I went into my team, and I think we were 5 people. And it became obvious to me that we were rocking. We were going to win that game. I could tell. I was so sure. We had a really good discussion. We challenged each other. We were not necessarily in agreement, but we ended up with a ranking we knew would be really good. And then we come back. And then the professor entered into a software, all our number one, number two, all the way to the down for every group. Can you imagine what was our ranking at the end?
Don't tell me it was the last.
No.
Okay.
We were number one.
Of course, that's about it. All right. I thought you were going to catch it. I thought it was like a riddle.
You fell into it. But then he did something which I did not expect. He had printed on a piece of paper what was going to be the ranking before we entered everything.
So he knew that you guys were going to be number one.
He revealed the piece of paper and everyone's ranking was perfectly aligned with the numbers. Everything.
How?
He knew in advance we would be the best team.
How did he come?
We were the team of average. We had no expert, no clueless. We were all average.
Wow.
And we could challenge each other to the point where we became the best performing team. And then the worst performing team, by design, it was
the experts.
It was 1 expert and 4 clueless or 3 clueless, but they were all aligned clueless. So they all believe, let's say, chocolate is number one. I don't know if it's true or not. They all were aligned on their ranking. And the expert, however they tried, they could not convince the clueless who were all aligned they could win. The number 2 team, if I remember right, was the same thing. It was 1 expert and all the clueless. But they were all orthogonal clueless. And so the expert could win the arguments against clueless because they were not aligned. And so what that means to me, and that changed my full trajectory about building teams. I'm not trying to recruit the very best of every roles. I'm trying to find the people who are very smart and very kind, but they can be average because I know that once we have the team dynamic and we have diversity of thoughts, so we're orthogonal enough, we are going to be a kick-ass team. And that's what I focus my time on, is to make sure that when I recruit people, they are going to have a different way of thinking from each other. And that's where the magic is created. So that program in INSEAD, that 1 day on decision-making, changed my way of building teams.
Wow. I've seen case studies. I've seen one case study whereby it was actually a real test. It was like there was 4 people sat on a chair, and there'll be a new person coming in for the interview. And when the interviewer came in, the first four, they were trained to stand up. So what happened is all four stood up, and the person that was coming new to the interview also stood up. And then they sat down, and then they brought someone else new, and they kept on doing it. And then you just had this like, I don't know whether you call it alignment or whether you call it a follower mindset. This is...
But that's different. That, I think, is a desire to fit and to follow what others are doing. And if anything, for us, we're not necessarily looking for people who follow others. I'm looking for authentic differentiation between people. And I can tell you, when I started recruiting, I just started TDK Ventures. So I basically wanted a team of 4. One was going to be the person, a startup liaison, linking the portfolio companies with the TDK teams. And I found the right person in Japan to do that, relocating to Silicon Valley. And I had 2 positions, and the intent was to have an investment director and an investment associate. And I had 17 candidates because we were just getting started. So we didn't have that many candidates like we have today. Yeah. And out of the 17 candidates, I ended up with 3. That was a finalist. And they were all at the investment director level. And I decided it's okay to go for 2 investment directors versus artificially trying to get a structure when we are such a small team. Now, what's interesting is that out of the 3, they were all thinking differently from me. So, tick. But one was very different from the other 2, and the other 2 were thinking very much alike. So I always tell, this guy got lucky because he was thinking differently from me and from the other 2. And then I had to choose between these 2 because they thought the same. And they were very different. One was American, one Chinese. They had different upbringing. On paper, they looked so different, but they were thinking alike when I asked questions, a way of thinking. And so I was very, very intentional when I recruit people, first to have people who think differently from me, but also from each other.
Right. Remarkable. Talking of convergence and atoms versus bits, what's remarkable is TDK Ventures sits in different avenues. You have the electrification side, storage, sensing, and computing, right? And also the other gentleman that I met early on with the flooding. That's an interesting one. We should talk about as well.
From DV-Rod.
From DV-Rod, yeah, remarkable. Can I ask you, what convergence trend do you feel that people underestimate the most?
I think it's something that 4 years ago, everyone didn't see coming. 2 years ago, some people saw it coming. Today, it's very obvious. Is a convergence of digital transformation and energy transformation. Or if I simplify it, electrification and AI. Right now, and it's interesting because now it's becoming so obvious that no one is talking about billions of tokens, they're talking gigawatt.
Right.
So it's becoming obvious to everyone that the real constraint today, it's not even the number of chipsets you get, it's the power to power them.
Right.
And so this is becoming obvious. But what's interesting is that if you think about from energy generation, transportation, storage, and some orchestration on top of that, to cooling, to the GPUs or LPUs or whatever chipsets you need, to memory, to connectivity, all the way to building tokens and then delivering applications that hopefully really bring value to society. There is a huge amount of bottlenecks. And the ingenuity of humans is that we are going to work on all these bottlenecks in a way that we've never done before. I think we are getting to the ingenuity level that we had when we built pyramids. Okay? It's getting to the point where the sharpest minds are working on the most difficult problems to get this powering AI to work really well, very fast, in a scalable way, with good unit economics. And so our job now is to identify these bottlenecks before they're obvious to everyone else. And that's where we are spending a lot of our deep exploration. Now, what's interesting is we are probably the only VC firm in the world to publish our deep explorations. You go to our website and you click exploration and you can see what deep explorations we are doing right now. You can also look at all the ones we've done before. And what's interesting is that you can even see who is driving which deep exploration. So we are not even hiding which ones we believe it's not obvious today, but will become obvious 4 years from now.
When you look at it, I mean, well, I think this is like the perfect time to dig into some of your investments. But let's talk about the gentleman that I just saw early on. Remarkable piece of technology where he has sensing apparatus, for example, that detects when a flood is about to happen. How did you spot this? How did it come to your table? And what made you say, right, this is something that we should be going on?
Actually, that one is interesting. So it's Javier, the CEO of DV-Rod. It's a company in Colorado. This guy worked for space agencies. He understands satellites. He understands the signal the satellite sends to Earth. He understands how it bounces onto water. And so the sensors he's built is basically sensors that can capture these signals that get reflected on the surface of water or snow or even land, and be super precise about sensing this information on a very wide surface. Okay? And what's beautiful about this is it can cover a very big area for a really good cost pricing, which means these unit economics are really good while being very affordable for many, many cities and regions that actually get flooded or landslides. Think about the benefit to society to have sensors who are real-time, accurate to the millimeter at very low cost. Okay? Think about all the machine learning that we are doing today on data that is updated at best once a day by a human looking at the height of a river and saying, on this piece of wood, this is that height. That's what we do today, which makes no sense when you have this technology that is real-time, all the time, super precise, which means you could have your AI to be way more precise in predicting flood. And even if it's 2 hours earlier prediction, and I think it could be better, but even 2 hours could save so many lives because you were in Dubai when there was a flood, right?
Yes.
If you knew 2 hours earlier than it happened, you could have done a few things differently, for sure. You could have gone home earlier. You could have got to get your kids from school earlier. So the value of having this precision improved dramatically is priceless. And so when we met with him, it's interesting. It connects to one of the other things we said, which is entrepreneurs deserve a better no. So this is an entrepreneur we met. And there was a few things we didn't like. And so when we passed, we said, we can't invest because of A, B, and C. If you can work on this, we will invest. Guess what he did? I mean, you already know the end of the story because, we invested. He worked on this. He came back and said, I worked on A, B, and C. And we're like, great, let's invest. So it was not an empty no, by the way. It was very, very intentional. We were very, very clear what it is that we're missing before we can invest. He worked on it, which, by the way, most people would just disregard a no from a VC. He was smart enough to say, wait a second, it's really detailed. It tells me what to do and what to think. I'm going to work on it. Not only it's good for he did because it helps him build the right business, but it made us realize that he's working on the right things, he's coachable, right. He's willing to be challenged. That's the trait of an amazing CEO.
Then you've got Fabric 8 Labs, which is tackling manufacturing at the atomic and microstructure level.
ACAM, 3D printing of metal.
Yeah. So what was the key aha moment that told you that this could scale industrially?
Well, first, we didn't know it could scale. Okay. We didn't even know the technology could work. Okay. There was huge amount of technology risk when we saw them. But I think I need to go back probably 12 to 18 months earlier. We had invested in a polymer 3D printing company called Origin.
Right.
And what's interesting about this one is this company got acquired very, very quickly. So it was a really nice success story. But when we invested in this company, of course, we reached out to all the TDK teams saying, hey, we've just invested in this company. Are you interested to work with them? And by the way, we've improved so much how we do it because now we understand what our TDK teams want. We understand their roadmap. So we already have an idea about what it is that they would want to work with. But at the time, we were just getting started. And a number of TDK teams, at least one in Austria, was very explicitly saying, we really don't care. That's not helpful to us. But if you find one that does with copper, with this type of precision, this type of performance, and this type of speed, and a long list of spec, we will love it. And so what we did is we start searching every metal 3D printing company all around the world. And I think we saw more than 50. How many could do the performance requirements of TDK out of more than 50?
Evidently just one then, I presume.
No, it could have been 5, but yes, it was one. Yeah. Good guess.
And it was Fabricate.
It was Fabricate Labs. And so we knew that of all the companies we met, they could be the king of the hill. And that's interesting because that list of requirements was a superpower for us, TDK Ventures, to be able to know which company would most likely fit to a market of billions of units produced every year, like inductors and so on, electronic components. And so here the intention is to try to understand what we can do. And we still have to prove it, by the way. It's not straightforward, but that company has the potential to build something that no one else could, that king of the hill concept.
Wow. Of course, you took a contrarian path investing in another company called Groq. I read your article where people evidently thought you were absolutely mad investing in them.
Yep.
And you went ahead. So instead of GPUs or TPUs, they built the LPU from the ground up. So I think it's important to ask, what was the moment that made you realize that this wasn't just another one of those 50 companies that are doing AI accelerators?
I think I mentioned it in the article, but I think the moment it became so clear to me was when I did the CEO interview. So what we like to do before we invest in a startup is do a CEO interview. Try to understand really how they think, the founders, how they think, how flexible, how convinced they are, how they are planning to build the business. So many questions we try to ask to get a sense of the CEO or the founder. And interviewing Jonathan was like, out of 60 minutes interview, probably 60 questions, rapid fire, real rapid fire. And his answers were sharp and smart and intentional. And it could be from the design of the chipset to how to build a team, to how to fire people, how to win customers, how to win partners, how to think about business model. He really thought through everything. And he had this high conviction, which was when he explains it to you and you're like me, a software and compute geek, it all makes so much sense. And yet no one understood how big inference would be and how big the streaming chipset concept that he had was a breakthrough. Think about it today. They have like the highest performance or one of the highest performance on inference in the world on a 14 nanometer technology. Imagine when they move to the next node, okay? They are working on a 10-year-old technology, outperforming everyone who's using the latest nodes. And that's because of the genius of Jonathan Ross and his design. And part of it, I remember during the interview how he explained it, which is the first 6 months designing the chip, we were not designing the chip. Okay? Counterintuitively, the first 6 months was spent on whiteboard building the compiler before you build the chipset. And that counterintuitive approach is what makes that chipset so powerful. So when you ask me the when, that was really the moment where I decided I have to invest. And by the way, I did something that you should never do. I invested more than 10% of the fund, 15% actually, in the fund in Groq. So talk about very high conviction to the point of doing what a newbie would do and you're not supposed to do.
Yeah, there's then the recent one. Congratulations on that one. Is Nubis. So Nubis is attacking the fundamental bottleneck of modern compute, which is I/O bandwidth. What insight made you believe that, optical interconnect, as one would say, or input-output, is ready for mainstream scaling?
I don't think it's ready for scaling.
You don't think it's ready for scaling?
I think we are still 3 to 4 years from that.
Okay.
But it's obvious this is going to happen. I think here the question is a when.
Sure. When, yes.
Yeah. And I think for Nubis, we were probably 7 years too early. And this is a big challenge. But there was no doubt in our mind that if there was a team that was going to make it happen, this was a team, world-class team. And I mean, at the end, they got just acquired really well, all-cash transaction by Ciena, because that Ciena can tell this is the right technology for what's coming, and this is a world-class team that can deliver on it. So here, this was really what I would call founding team, technology, and market fit. And what's beautiful about that is their technology is world-class, but they understood the market. Now, the challenge was the timing. I think copper is proving to be way more resilient as a technology than anyone would think about. And so here, this is one where we probably were too early, but this is one where we ended up with really good returns financially. And we are working with what I would believe to be a world-class team. And even though they've been acquired by Ciena, we will engage with Ciena. So TDK has built intimacy with a team that is now in a bigger company that's going to be shaping the future of connectivity. So from my point of view, this is a success. Financial returns, strategic returns, intimacy with a market leader in the making.
Wow. I want to go back to what you were talking about in terms of your perspective on how you treat entrepreneurs. And as potentially, of course, there's customers. And of course, running the NPS, which is something I adopted from your advice a long time ago in my organization. So you mentioned that you collect this information, and the information goes from recommending it to another entrepreneur that you said.
I can explain first.
And I'm just recapping. I want to make sure that I'm listening right, because I need to adopt this as well. So you asked whether they would recommend TDK to another entrepreneur. Then you ask them what worked well with them, and then what didn't work well. And you do it in a structure whereby you make them feel comfortable about saying something positive, so they can be brutally honest on the latter part. So what I want to understand is that with this NPS, you mentioned that you share it during a reflection week that you have. So once you share, what's the changes that go straight away? Do you make those changes imminently, or?
First, I need to be clear. We're not asking what didn't work well. We're asking what can we do better?
What can we do?
And that way you get both a negative feedback as well as a positive feedback. The second thing, which I think is important, is I'm sending the email to everyone. So it's basically an email. It's not a tool. It's an email where I simply say, please reply in line to these 3 questions. And what I'm expecting is if people want to respond in 1 minute, that's easy. But many times they will spend 10 minutes, 20 minutes giving high quality feedback. And I respond to every single one of them. The last NPS survey we did was 300 emails, plus the back and forth. But I find it super enriching for me because I end up communicating with all these portfolio companies and investing partners in a way that help me to really understand what we're doing well and what we can do better, and to engage with them. Now, of course, once we have all this information, we discuss it as a team, and the team has time to prepare their proposal. So they are basically saying, this is what they are saying, this is what we are proposing to change. This is what they said they don't like, we are going to stop doing it, or we are going to do it differently. So there is a lot of improvements we make based on what our customers are saying, the entrepreneurs. And that is very important, that it comes directly from me to them, and they feel comfortable about it. The most important thing is after reflection week, once we've decided to make changes, go back to them and say, hey, thank you for your feedback. And that's the kind of improvements we made. And that, I think, is how you get trust that asking the questions will lead to action, so that next time I'm asking them, it helps as well. And what's interesting is that some of the feedback we get are useful for the next investments we make, not for the current one. For example, we get feedback about our due diligence being too long or our check size not being communicated clearly. That's too late for them. We've done that mistake, but what we can do is improve it. We can improve it for every future investments.
So you've spoken about CVC 3.0, which is basically, I mean, could you talk about it? See, what is CVC 3.0?
Well, first, I think it's good to understand what CVC was. And some people even called it dumb money at the time. But CVC 1.0, the original CVC, typically were very strategic. They wanted to invest for an exploitation mission, typically, and they would ask for hooks. And so the visual I have for CVC 1.0 is a hook. You get the money, but in return, you have to tell me if you get acquired so I can acquire you first. You have to work with my team. You have to do this. That's the 1.0. We have moved on from that as an industry more to 2.0. And 2.0 is basically the way you could think about a balance between strategic and financial. And it's a false choice because actually there is no balance. But some people think that if you try to be too financial, you're going to be less strategic. And so there are a lot of CVCs that believe in that balance. And I think because of that, they are going to underperform on both. What I believe is a CVC 3.0, where you are actually understanding that financial performance as a VC firm and strategic performance as a strategic VC firm are correlated. Okay. And I'll make it very simple for you and your audience, which is if all of my 49 portfolio companies goes to zero, my financial performance is zero, my strategic value is nearly zero. Okay, I might have learned where not to go, but that's really terrible, okay? Let's assume for a second that all my 49 portfolio companies become highly successful, beyond unicorns, market leaders. My financial performance would be more than any VC in the world, okay? If they were all fund returners, let's be clear. But I would have built immense strategic value because every portfolio companies would become the ideal market leader, partners, supplier, customers to TDK, building intimacy from the very beginning as they start in seed or Series A. That strategic value would be off the roof. And so I think understanding that CVC 3.0 is basically understanding the high correlation between financial return and strategic return, which basically means stopping believing this is an assumption to be made about are you strategic or financial. There is nothing strategic in losing money.
No. We have to do another podcast because there's so many more questions that I have to give to you.
Yes, it's too short.
It is very short. Thank you, Nicolas. I mean, just to wrap this discussion up, what's one message that you feel is vital that you want the audience that's listening to this or the world to understand?
I think it's all about entrepreneurs. I think the future relies on people building a better future for us. Us as corporate VCs or VCs, our job is to help the best entrepreneurs build a better future for us. And the reason I'm spending time with you on this podcast is I'm hoping some of the audience will get some ideas about how to do venture capital better. Not because I really care about venture capitalists, but I care about the entrepreneurs they will be supporting. And if they can bring their superpower and better support to the entrepreneurs with a customer mindset for the entrepreneurs, I think we are going to be ending up so much better as society.
Nicolas Sauvage, thank you for joining us on the Semiconductor Leadership Podcast. An enlightening discussion as always. I expected it to be like this. Definitely round two needs to happen. Ladies and gentlemen, thank you for joining us on the Semiconductor Leadership Podcast. If you want to reach out to Nicolas Sauvage, you can connect with him on LinkedIn here. And also you can visit the TDK Ventures website right here to learn more about them. As the motto says, it takes a village to raise a chip. So, and it also takes subscribers to raise a podcast. So hit that subscribe button. And if you enjoyed it, please share, like, and comment. Other than that, until next time.
No. Show your book. Show your
the next episode. Actually, yeah, I might as well.
Come on. It's right here.
Yes. So this is the first prototype, the first announcement. The game of chips is out. If you are a semiconductor veteran or someone that is curious about the semiconductor industry and you're eager to understand the ecosystem from start to end, this is the book you need to order. You can get it direct on Amazon, hardcover, paperback, and ebook. So, and then I'll get Nicolas to do the audio narration with his wonderful French accent. Thanks again for joining. Nicolas, thank you again for your time.
Thank you, Salah.
Yeah. Take care and bye for now.